Welcome back to the channel. Hope you guys have been doing well. In this video, we're just going to cover a little bit of macro, and I'll end the video by talking about how I'm allocating 30 to 40% of my portfolio. I got a vacation plan that's starting in a couple of days, but I want to share a few of my thoughts before I head out for my trip. Because of the few side gigs that I have in real life, I usually don't have enough time to produce videos for you guys, but I do my best to give you guys alpha in my private Discord channel. It's free for everybody to join. If you guys are interested, just click the link in the description below. Most people that I know that did really well in the previous cycle, they spent a lot of time grinding through Discords and collecting alpha. So if you want to be in a position to kill it in the coming cycle, I strongly recommend that you guys join as many alpha Discords as you can. With that being said, let's go ahead and dive into this video. All right, in this video clip I'm about to play, the guest talks about how the Fed is going to target inflation by bringing up the unemployment number. Now, prior to watching this video, I assumed that they were doing that because the net result would be fewer people employed, resulting in less money chasing the same amount of goods and services. But also on top of that, if you have people competing for a smaller pool of jobs, then you should also see the wages come down. So the net effect of higher unemployment is lower wages and fewer people with jobs. But the guest here mentioned something a little bit extra that I didn't take into account. He also talked about how wages are baked into goods and services. So if wages come down, that in itself will allow businesses to bring down their prices. And generally speaking, whenever I play these clips, I don't necessarily agree with everything the guest or the host is saying, because you can never agree with somebody 100%. But what I like to do is just take inputs from different sources and use them to compute my own opinion. Now, with that being said, let's go ahead and listen to what the guest had to say.
Brian, I agree. This is not a recessionary environment at the moment. But remember, the Federal Reserve is going to continue to raise rates. And as Jordan correctly points out, 75 basis points, I think, is still in the cards. I think he's spot on. And so as that continues, and you've seen the money supply go down from close to 27.5% the year before on a year-over-year growth rate to less than 5% now. So I think we still can't rule out the possibility of a recession in the next 12 months. But for now, absolutely, the numbers don't suggest that. The unemployment rate picking up, that is correct. But the Federal Reserve is going to look at this and say, why did the unemployment rate go up? It went up for a good reason. The household survey is still showing more than 400,000 increase in labor. So it's not because there are no jobs being created, but rather because a lot more people are coming into the labor force, which is exactly what you want in this environment, because that means lower wage pressures. This is something that we're going to be watching moving forward, and something the Federal Reserve wants. Less inflation pressures from labor, because the 2/3 of the average cost of producing either a good or service is accounted for by labor costs. So if labor costs are increasing, there's no doubt that that's going to mean upward pressure for consumer prices, whether you're looking at the CPI or you're looking at the personal consumption deflator. This report really looks like a Goldilocks type of report.
Before we move on to the next clip, I wanted to highlight why I was showing you these clips to begin with. Most people over the last few months have been focused on CPI for the right reasons, but in my opinion, moving forward, the focus is going to shift from the CPI to unemployment. Remember, the Fed can only combat inflation by addressing demand. Where does the demand come from? It comes from consumers, people who are making money and spending it. And what's a good way to get people to spend less? You take away their job. And on top of that, you have to remember, when people lose their jobs, in most cases, they become more frugal and conservative with their spending. So instead of using their disposable income to go out and eat, go on vacations, maybe dollar cost average into some crypto, in most cases, they're probably going to stop all of that until they get another job. Now that I've highlighted the point, let's go ahead and play another video that reinforces my view of the focus shifting from CPI to unemployment.
So I made note of that. Apparently he'd said it before, but he certainly made a point of emphasizing it. This idea of there will be some pain for businesses and households. How did you take that to understand how far the Fed is willing to let unemployment rise?
Yeah, I mean, so the first hints came in the June SEP, where they actually forecast a rise in the unemployment rate by 0.5 percentage point. But if you look at where ECI wages are, they're growing 7% annualized. They're just way too fast. And to have any comfort that that number is going to come down to something that's more sustainable with a 2% inflation target, they just have to get the unemployment rate, by my estimate, up to something like 5 to 5.5%. And so I think that you're going to see their own estimates drifting higher and higher, and that we will end up in the middle of next year somewhere with an unemployment rate in the 5s, because the Fed has chosen to do that. And we can argue whether or not that's the best policy or not, but we just have to, as investors, accept the fact that that's what they're deciding to do, and it's going to happen. And it's just a question of what level of short-term rates induces that change.
All right, I think I've made my first point very clear. Now, the second thing I want to talk about is actually a very bullish case for crypto. QE can come in different forms if the net result of policy decisions lead to the expansion of the money supply. It's a form of QE. And anytime you have a rapid expansion of the M2 supply, in theory, you should always see assets priced in that currency go up. For now, as most currencies go to shit, investors are flocking to USD. And for that reason, you've seen USD go on a strong rally. But what happens after the dollar goes on a strong rally? Well, the tweet that I'm about to read goes into some game theory and outlines what he or she thinks could potentially happen over the next 6 to 8 months. Authored by this Twitter handle here. I mean, prior to this thread, the dude had about a few hundred followers, but he blew up after he wrote this really good thread. His tweet reads, "We're about to experience a sovereign debt crisis caused by Europe energy crisis. All a capstone on the 100-year fiat experiment. Here's how I think the next 6 to 8 months go down. Putin strong-arms Europe by shutting off energy pipelines, causing a spike in prices. This causes energy prices to skyrocket in Europe, which is a major component of CPI. This causes inflation to explode higher. As CPI explodes higher, electricity prices get passed to consumers, eventually at the risk of civil unrest, revolution over refusal to pay this. The Euro government has two options. Number one, give in to Putin and let him have Ukraine and stop the sanctions to get energy flowing again. Number two, decide to deploy price caps on energy for consumers and print the difference. To achieve this, I believe ECB needs to instill yield curve control to keep sovereign bonds intact and avoid fragmentation of EU sovereign bonds. Game theory I've ascribed to this makes me think that the West is too far deep into this mess to give into Putin and would rather print the difference. The saying goes, no government ever willingly went broke through austerity. Yield curve control is going to cause DXY to explode higher because 58% of DXY is euro. DXY to $150 milkshake theory type of shit. The dollar wrecking ball will cause emerging markets to begin potentially defaulting on their debt, forcing them to sell their US bonds to US dollars to defend their currencies, forcing them to sell their US bonds to buy US dollars to defend their currencies. As emerging markets sell US bonds to amass dollars to defend their currency, US bond yields will explode higher, causing systemic risk to US markets as everything is priced off US treasuries. The Fed then has two options to fix this, which I believe they will explore both. Swap lines with ECB and BOJ. They launched a standing swap line facility in July 2021 to make this easy. This allows them to easily lend dollars via central bank reserves to these central banks, which will help bring down DXY and stabilize foreign forex markets. They can also use their standing repo facility to provide overnight loans to stabilize funding treasury markets on short duration bonds. Parentheses, they are making sure that the New York Fed staff knows how to do this. The usage of the swap line facility and repo facility is net stimulative and will cause DXY to come down and markets to stabilize. And in parentheses, though I believe everything will be nuking during this time as correlation goes to 1. In conclusion, I think we're at the end of a major sovereign bond bubble, and this energy crisis is the catalyst. The Fed will be forced to stimulate or risk full implosion of the monetary system. What will be unique about this time, oil will still be going higher, not lower. As the game theory plays out, our goal is to find the optimal moment to long the fuck out of our favorite crypto Ponzi's. I see many takes from people who think QE is never coming again, but it will. Just under other names. Get ready to max the long after this coming flush. Now, everybody out there is trying to approximate what's going to happen over the coming months because most people who are in cash at the moment, they know in the long run, fiat is trash. It's going to continue to trend towards zero. And so the market participants that still have cash, they want to deploy their funds at the optimal time, meaning they want to buy the bottom. Now, most market participants aren't going to be able to catch the bottom, but what I'm doing is I'm waiting for some signals. And in my view, I think a lot of what's outlined in this tweet has a pretty good probability of playing out. And if you start to see some of this materialize, for example, you hear that EU is getting ready to put a cap on energy cost, then you might want to wait a little bit before you begin building your position. Personally, I'm waiting for a couple things. I'm waiting for the unemployment number to go up, and I'm also waiting to see what kind of monetary policies are adopted by the various central banks. The focus obviously being the Fed and the European Central Bank. All right, to finish the video, I'm going to show you guys how I tentatively plan to allocate to the Solana eco. I'm probably going to take about 30 to 40% of my portfolio and spread it across the Solana eco, adhering to the following allocation. 40% I'm just going to be in spot SOL. I'm probably going to be staking it in various forms, either directly in a validator or through a proxy. For example, a lot of DeFi protocols have a liquid staked version of SOL. And the goal here is basically to spread around the risk and also passively increase my SOL position. Next, I'll also buy high conviction alts. For now, that's Dust, Shadow, and Forge. In this video, I'm not going to go into why these are my high conviction plays, but in a future video I will. Or if you can't wait for the video, you can definitely ask me in my private Discord. Next, I want to go ahead and get exposure to some blue chip NFTs. I've only listed 3 here, DGods, SMBs, and SSC, because I'm very confident that they're going to be relevant in the future. But I think the list of blue chip NFTs is going to be growing, especially during the course of the next bull market. So I'm going to keep an eye out for NFTs that have blue chip potential. And lastly, I'm going to allocate about 10% to high risk alts and NFTs. So that includes, but is not limited to, GFI, Ori, Sentries NFTs, ABC NFTs, Panzer GameFi NFTs, Guild Saga, which is another GameFi NFT. Basically, I'm going to explore NFTs that have the potential to go up over 20x, ideally 100x. Basically, any project with a very low market cap that I think has significant upside potential, but also is a lot more risky than some of the more proven projects out there. And for those of you guys who've stayed until this point, just to give you guys a little bit of alpha, for most projects I invest in, I'm pretty simple. I mostly look for 2 things. Number 1, I look at the team, because it doesn't matter how good your idea is. If you're not able to execute and stay committed, the idea is going nowhere. In fact, a team could steal your idea and end up taking more market share because they're just able to execute better and faster. The second thing I like to look at is the community, because getting a community to coalesce around your project with properly aligned incentives is a huge competitive edge in the Web3 space. The community basically comes free of charge, and because they have a vested interest in the project's success, they're going to be shilling the project nonstop. And the best combination is when you have a quality project that's aiming to do big things, attract high quality community members who end up acting as the PR or marketing arm for the project at no cost. And there's actually other reasons why communities are very important for projects. But for now, I think you guys have a pretty good sense of what my general framework is for investing in projects. So far, most, not all of these projects fit within my investment framework. Now remember, I said that this is my tentative plan. It could change over the coming months. If you wanted to stay up to date with everything, you can follow me on Twitter, subscribe to my YouTube channel, and definitely check out the Discord if you're interested in getting information in real time or having a discussion with me. All the relevant links can be found in the description below. With that being said, I hope you guys enjoyed today's video. This is CryptoOneStop signing out. I'll talk to you folks next time. Bye.